Imagine for a second that you could go back in time. Not to the 1980s, but just 10 or 12 years ago. Imagine you had put $10,000 into a company called Tesla when it was just a struggling electric car startup. Or imagine you bought Shopify before every small business in America was using it. That single decision wouldn't just be a good trade. It would be a life-altering event. A 10-bagger, a stock that returns 1,000% or more, turns a modest $10,000 investment into $100,000. And the best ones? They turn that same $10,000 into $500,000 or even $1 million. Most of us are taught that investing is a slow, steady grind. We're told to buy an index fund, hope for 8% a year, and wait 40 years to retire. And look, that works. It's safe. It's reliable. But it's also slow. The legendary investor Peter Lynch, the man who ran the Magellan Fund, didn't play it safe. He averaged a 29.2% annual return for 13 years. He coined the term 10-bagger because he was constantly hunting for stocks that could multiply his money 10 times over. If you had invested in his fund, $10,000 would have turned into nearly $280,000 by the time he retired. But here is the problem. Peter Lynch retired at age 46. The market he invested in, the market of the 1980s, is gone. The rules he used to find winners, like buying stocks with low P/E ratios and immediate profits, simply don't work the same way in the modern era. If you insisted on buying only profitable companies in the last decade, you would have missed the biggest winners of our generation. You would have missed Amazon. You would have missed Tesla. You would have missed the entire cloud computing revolution. So, how do we find the next 1,000% winner? I just finished reading an incredible research report titled, The Ultimate Guide to Modern 10-Baggers. The researchers didn't just guess. They analyzed every single U.S. stock over the last 20 years, roughly 5,000 companies. They used AI to crunch millions of data points to find the true 10-baggers and figure out exactly what they had in common before they exploded. They found a specific set of 4 traits, the core 4, that less than 1% of stocks possess. If you can find a stock with these 4 traits today, the data says you aren't gambling. You're following a blueprint. Welcome to Nerd Financial Path. Today, we are going to break down that blueprint. We are going to look at the math, the specific companies, and the exact checklist you need to find the next 10-bagger. Buckle up. Let's start with the data. Out of roughly 5,000 publicly traded U.S. stocks in the last 20 years, how many do you think hit that magical 1,000% return mark? The answer is shocking, 1,651. That is nearly 1 in 3 stocks. Now, before you get too excited and start throwing darts at a stock ticker board, you need to understand that most of these 1,651 winners are what we call false positive 10-baggers. They hit the number, but they were uninvestable for the average person. The report spent a lot of time filtering out the noise to find this signal. Here is what they threw out, and why you should avoid them too. First, the penny stocks. These are stocks trading for pennies that might jump from 5 cents to 50 cents. Sure, that's a 10-bagger mathematically, but it's often due to manipulation or low liquidity. It's not a business winning, it's a casino game. Second, the cyclical traps. This is huge. Companies in mining, energy, and commodities often 10x when the price of oil or gold spikes. But guess what? When the commodity price crashes, the stock crashes 90%. Unless you have a crystal ball for oil prices, these aren't long-term holds. They are traps. Third, the binary biotech bets. We all know a guy who made a fortune on a small biotech stock because the FDA approved their drug. But for every one winner, there are 50 failures that went to zero. Relying on a single FDA approval is a coin flip, not an investment strategy. Fourth, the meme stocks. Remember GameStop? In 2020 and 2021, GameStop shot up 7,900% in under a year. It went from under $1 to over $80. But look at the chart. It came down almost as fast as it went up because there were no fundamentals supporting it. It was a flash in the pan. We are not looking for a lottery ticket. We are looking for the true 10-baggers. After filtering out all the junk, the researchers were left with just 347 stocks. These are the elite. These are the companies that didn't just spike for a week. They grew and grew and grew and sustained those gains over years. The average overall gain for this group? 6,768%. Let that number sink in. 6,768%. That turns a $10,000 investment into nearly $700,000. And you only need to find one of them to change your life. So, how do we find them? The data says there are two paths. The first path to a 10-bagger is what I call the crisis strategy. The data shows that during massive market crashes, specifically the 2008 global financial crisis, hundreds of high-quality stocks became 10-baggers simply because they got too cheap. The report calls these the 2008 survivors. These weren't necessarily high-growth disruptors. They were boring, established companies that got crushed by panic selling. Take Ford. In 2009, Ford was trading under $2 a share. It was priced for bankruptcy. But it didn't go bankrupt. It survived. And by 2022, it touched $20 a share. That is a 10-bagger. Take Caterpillar or Delta Airlines. These are massive, mature companies. Under normal circumstances, they might grow 10% a year. But because they were priced at apocalypse levels, they offered 1,000% returns to anyone brave enough to buy the bottom. To execute this strategy, you have to time the market perfectly. You have to wait for a once-in-a-generation collapse, and then you have to have the guts to buy when everyone else is selling. That is incredibly difficult. It relies on luck and timing. We don't want to rely on the next global financial collapse to make money. We want a strategy we can use today in a normal market. That brings us to path number 2, the fundamental framework. This path doesn't require a crisis. It requires finding companies that are fundamentally superior. The research identified that the true 347 winners share 4 specific traits, the core 4. If a stock has these 4 traits, it has the potential to 10x regardless of what the Federal Reserve is doing. Let's break down trait number 1. If you take nothing else away from this video, remember this: revenue growth is the king. In Peter Lynch's day, he looked for earnings, profit, growth of 20%. But in the modern economy, the biggest winners prioritize revenue scale above all else. The researchers analyzed the revenue growth of the 347 winners and compared it to the S&P 500. The difference is staggering. The S&P 500 averages about 5% revenue growth per year. The 10-baggers? In the year their run began, they averaged 22% revenue growth. Within 4 years, that accelerated to 38%. They were growing 5 to 9 times faster than the average company. Let's look at the specific data for the giants we all know. The report breaks down their growth rates year by year before they ever made a consistent profit. Look at Tesla. 10 years before it was consistently profitable, its 3-year compound annual growth rate for revenue was 140%. 8 years before profit? 158%. It never dropped below 50% growth for nearly a decade. Look at Shopify. 6 years before profit, it was growing revenue at 105%. 5 years before profit, 98%. 4 years before profit, 86%. This is what we call the grow now, profit later model. These companies were capturing land. They were growing so fast that they couldn't possibly be profitable. They were hiring every engineer they could find, building every factory they could sketch, and acquiring every customer they could reach. The study found that rapid, consistent revenue growth is the #1 predictor of 10-bagger returns. The checklist rule: when you are looking at a stock, calculate its 3-year revenue CAGR. Is it under 10%? Walk away. It's likely too mature. Is it over 20%? Now you're interested. Is it over 50%? That is the sweet spot where the super performers live. But be careful. Growth alone isn't enough. A company can grow fast and still fail if it's too small to survive or too big to double. That leads us to trait number 2. Size matters. Peter Lynch had a famous saying: it's hard for a $50 billion company to grow much, but a $500 million company can double in size relatively quickly. Think about the math. If you buy Apple today at a $3 trillion market cap, for you to make a 10-bagger return, Apple needs to become a $30 trillion company. That is larger than the entire GDP of the United States. It is mathematically impossible for that to happen in a short time frame. On the flip side, if you go too small, investing in companies worth $10 million or $50 million, you are entering the danger zone. These are often pre-revenue experiments. They are fragile. One bad quarter, one lawsuit, or one recession, and they go to zero. The research found a sweet spot, a Goldilocks zone where the probability of a 10-bagger is highest. The sweet spot, $200 million to $20 billion. The data is clear. 73% of the true 10-baggers started in this range. The average starting market cap was $3.3 billion. The median was $750 million. Let's look at where some of the biggest winners started. Monster Beverage started at $350 million. It gained 15,000%. Salesforce started at $1.4 billion. It gained 10300%. Nvidia started at $3.8 billion. It gained a mind-blowing 82,300%. This is arguably the most actionable rule in the report. If you are hunting for 10-baggers, you should ignore the S&P 500 giants. You need to be looking at the mid-cap and small-cap indices. You are looking for companies that have already proven they have a real product. They aren't tiny microcaps, but they still have the entire world left to conquer. Also, for those who love cheap stocks, the median share price for these winners at the start was under $15.20 of the 347 stocks were trading for less than $20 a share. Psychologically, it's easier for a $15 stock to go to $150 than for a $1,000 stock to go to $10,000. This next trait is going to go against everything your grandfather taught you about investing. If you look for companies that are losing money, you are actually more likely to find a fast 10-bagger. The study found that 59% of the true 10-baggers were not profitable at the start of their run. But here is the kicker. Unprofitable companies reach 10-bagger status faster than profitable ones. Profitable companies took an average of 7.5 years to 10x. Unprofitable companies took only 6 years. In fact, look at the list of the top 10 fastest 10-baggers in history, the ones that delivered 1,000% returns in under 1.5 years. 80% of them were unprofitable when they started. Celsius Holdings, unprofitable. Tesla, unprofitable. Enphase Energy, unprofitable. Moderna, unprofitable. But how does losing money make a stock go up? It's called being intentionally unprofitable. There is a massive difference between a company losing money because its product sucks and a company losing money because it is reinvesting every penny into growth. Amazon spent 20 years barely showing a profit because it was building the logistics network that now rules the world. Meta didn't monetize for years because it wanted to reach 3 billion users first. These companies are building a moat. They are spending on R&D and marketing to make sure no competitor can ever catch them. The switch test. When you see an unprofitable company, ask yourself, if they stopped growing today, could they be profitable? If Amazon had stopped building warehouses in 2010, they would have instantly been profitable. But they chose not to. They chose world domination over quarterly earnings. The report suggests checking the CEO's vision. Are they apologizing for losses, or are they bragging about their reinvestment? You want the CEO who says, "We are spending money now to own the market later." We have covered growth, size, and profitability. Now let's talk about sector. Where do these 10-baggers live? Unsurprisingly, technology is the #1 breeding ground. But tech is a broad term. The research gets more specific. The biggest, most sustainable gains come from platform technologies. A platform is a base layer. It is the foundation that other businesses build upon. Platforms are magical because they are scalable. Once you build the iPhone iOS, it costs Apple almost nothing to add the next million users, but every new app developer adds value to their ecosystem. Look at the list of platform 10-baggers. Amazon, the platform for e-commerce and cloud. Shopify, the platform for small business. Salesforce, the platform for customer management. The Trade Desk, the platform for digital advertising. ServiceNow, the platform for IT workflow. These companies became the plumbing of the modern world. The piggyback strategy, but here is a pro tip from the report: you don't always have to identify the platform creator. Sometimes, the easiest money is made by piggybacking. Piggybacking means investing in the companies that use a new platform to build a massive business. Apple created the smartphone platform, but Uber and Airbnb became giants by piggybacking on that technology. Netflix created the streaming platform habit. That created the need for the Trade Desk and Roku. Amazon created e-commerce comfort. That allowed Wix and Shopify to thrive. So, what is the next platform? The report points to artificial intelligence as the new base layer. Just like the internet spawned Amazon, and the smartphone spawned Uber, AI is going to spawn thousands of new applications. We are also looking at robotics, genomics, and self-driving tech. Don't just look for the company building the AI chip, like NVIDIA. Look for the company using AI to revolutionize healthcare, or law, or logistics. That is where the next wave of 347 winners will come from. Let's recap the core 4 checklist. If you want to find a modern 10-bagger, you are looking for revenue growth, a 3-year CAGR of at least 20%, ideally much higher. Market cap, a Goldilocks size between $200 million and $20 billion. Profitability, either profitable or intentionally unprofitable, with aggressive reinvestment. Platform focus, a tech-centric business that acts as a foundation for an industry. Peter Lynch famously said that he missed his daughter's birthdays because he was too busy memorizing 2000 PE ratios. He retired at 46 to buy back his time. That is the ultimate goal of investing. We don't do this just to see a number go up on a screen. We do it to buy freedom. The beautiful thing about the 10-bagger strategy is that the math is in your favor. You can be wrong on 5 stocks, lose 50% on each of them, and then be right on one stock that goes up 1,000%, and you still come out massively ahead. You only have to get rich once. The 347 companies in this report proved it's possible. The next 347 are out there right now, trading under $20, burning cash to grow, and waiting for someone to notice them. If you want to dive deeper into this data, I've linked the full research report in the description below. Go check it out, it's worth the read. If you enjoyed this video, do me a favor, smash the like button to help this channel grow, subscribe for more investing content, and let me know in the comments, what stock are you watching right now that fits the core 4? Thank you for watching, and I'll see you in the next video.